Welcome to TheoTRADE. This is Don Kaufman. It's March 13th, 2024. Just about an hour left to trade in this Wednesday session. S&P futures at this point are massively unchanged, but I got to tell you, it's not the S&P futures that are on my mind right now. Okay, it's not any of the price action of the market. It's what's right ahead of us. And that is the triple witch returns with trillions in risk to the marketplace. Allow me to explain that and much more here, of course, on this TheoTRADE evening video. To begin with, for those of you that are aware, options, of course, they expire. And if you take a look at an option chain, some of the expirations are every single day. It's Christmas every day, right? Trader's paradise over here when you look at something like the SPX or the spiders, okay, literally there's expirations every single day. And of course there's end of the week expiration, which is every Friday now has expiration. And that basically is like every equity product. We'll take a look at Meta really quick. And of course there's Friday expirations. But a few times a year, specifically 4 times a year, you get what we term triple witching. Now, some of you been around a while, you'll hear the terms quadruple witching. Don't ever use that terminology around me, okay? Doesn't matter. Let me explain what the triple witch means. First and foremost, right here, the E-mini S&P 500 index futures, okay? Those, okay, are going to go into expiration. When do they actually technically expire? What they call a Friday morning opening print. Now, okay, the opening settlement, opening print do actually differentiate from one another. And the way this is actually done, it's calculation, okay, off of what we term a settlement, okay? It's a settlement value. Now, the index, okay, futures will expire at the exact same time. You actually have an SPX expiration. And the SPX is really interesting because now there's what we term an AM cash settlement and there's a PM settlement on there. The AM settlement is absolutely critical because I'm going to tell you right now, therein lies trillions of risk. So, all right, first of all, we have what? Index futures. Then we have actually index options. What's the third aspect? Third aspect, of course, would be equity options. And the equity options, of course, expire as well. Now, time out. Okay, so why do you hear the terms quadruple witching? Years ago, a product was established. That product was actually called single stock futures. The product never really took off, but you know, people started using the terminology quadruple witching. That's why I said never want to hear that terminology. It's the triple witch, and the triple witch lives. Now, lately, okay, there has been phenomenal amounts of options volume. Okay, just to give you an idea, like the SPX today, I mean, look, the S&Ps are not doing a whole lot today, right? They're slipping a little bit, down a massive 3, being a little sarcastic with that one. But the SPX still good for 2 million contracts. If you take a look at the SPX, you also, it's worth looking at the spiders because the spiders and the SPX kind of mirror each other. The spiders are good for like 5 million contracts. Just to give you an idea, like any given day, the marketplace right now does about 48 million contracts total a day. When I say total, I mean in any given day, all the option contracts that trade between spiders and SPX and all the equity products, it equals about 48 million. That's about average, and that's from the OCC, which is the Option Clearing Corp report. All right, but it doesn't matter that's 48 million. Who cares? What really matters is that the SPX is a $5,170 product. And you look at it and you go, it only traded 2 million contracts. I mean, come on, Don. Tesla's probably doing, you know what? Take a look at Tesla for a second. I just want to just bear with me here. Tesla's doing over that, right? Tesla's worth 2.2 million contracts. That's trading even more. Yeah, but Tesla's a $170 stock, okay? Which what we term on a notional value basis, that doesn't even, like, that's a rounding error, you know? You're looking at the SPX, and there's a reason that I call the SPX the mother of all products. It's the mother of all products because it's a $5,170 product. Granted, there have been stocks that have been above that level, but you have to understand doing 2 million contracts of something of that magnitude. And then you have the spiders, which is a $500 product, trading another, 5, 8, or even 10 million in a day. We are rocking. Now, why does this triple witching that's right ahead of us, why does it matter so much? And I'm going to tell you right now, okay? I'm getting ahead of the game. It's Wednesday. By Thursday, everybody in the industry is going to be talking about this. And I really mean that because there's trillions coming off. Let me show you. In the AM settlement, and this is not exactly the most retail friendly settlement. This is where some of the biggest traders in the world will go, okay, to either place trades, lay off risk, whatever it might be, speculate. And as I'm actually scrolling through here, you can see how many options are on here, okay? How many options are on those option chains? It's phenomenal. Like, look, I can grab this little scroll wheel. Okay, this is open interest. And for those of you that have no idea what open interest is, it's how many contracts are basically open. Like, look, you know, this stuff is so far out of the money. It's stuff trading for 35 cents. Like, oh, that 50,000 contracts of the 4,700 puts. Right, no one cares. That's exactly right. No one cares. Okay, where you going to care, where you should care, is when you start looking right around what we term kind of near money stuff, like the 5150s. Let me actually highlight these for just a second. I'm going to highlight it, and I'm actually going to highlight some of the open interest in here just so everybody sees it. All right, so what do you got in terms of open interest here, the 5150s? Just to make a point. On the put side, it's about 65,000 contracts. On the call side, you got about 71,000 contracts. Now, one of these two is going to end up in the money. What's in the money? Well, in the money basically means 1 penny or more in the money. Either we're going to close above 5150 or we're going to close below 5150. Either way you want to put it, think about all the risk on that. Okay, so if you looked at this, it's 65,000 contracts of puts, about 71,000 contracts of calls. Let me add that up. What is that? I'm just going to round. Okay, I'm just going to round over here. Let's not get too crazy. What is that? About 135,000 contracts total. So I'll put that up here. It's about 135,000 contracts. Now, contracts, you would want to multiply that by, of course, 100 into shares, and then it's a it's a 5,000, you know, right here, $5,171 product. And we do some math. It's like 135,000 contracts times 100. Okay, basically times 5,170. All I'm doing is figuring out, roughly speaking, the notional value. Do some quick math. 135, carry the 0 over there, times like 5. You're probably in the neighborhood of about $70 billion. Okay, that's $70 billion. That's just one strike. That doesn't include all the other strikes around here, the 5100s. And you think about this, people, there's going to be trillions that are coming off. And what people miss about this, okay, who cares, man? So what? Some $1 trillion. Therein lies actually a big issue. A couple of $1 trillion is coming off, but the SPX has no underlying. When you start clicking on the ask, it's going to say, this is not a tradable product. Good, it's not a tradable product. You know what the hedge is? The hedge is the S&P futures. And I'm going to tell you one thing. Come Friday morning, oh yeah. So when those trades go off, right? Opening print happens, and the settlement then takes place. When I say the opening print, so right out of the gate, boom, the marketplace, that's over, right? You can't trade it that morning, but it goes off of into a settlement. So once the settlement happens, trading firms have to rip some of the hedges off. Okay, not knowing exactly where it's going to open, though, can always make things a little bit more interesting. Nevertheless, they can actually rip off hedges. It is billions and billions, okay, in hedges that get ripped off because of trillions of dollars that are going to expire. People, that's just the SPX. These quarterly expirations in equity products, I'm going to move hedges around all day long inside of the S&P futures. I think you need to be prepared for some volatility forthcoming. And I'm telling you right now, everybody will be talking about it by tomorrow, which is Thursday. And I'll cover it a little bit more on Thursday live in TheoTRADE, simply because, yeah, this is what's right in front of us. This is what's going to matter. And it's going to matter even more than, like, you can look at the calendar all you want. Oh, no, PPI final and manufacturing sales and jobless claims. Oh, my. Now, what's in front of us is going to be Friday. And Friday is going to carry some volatility. And I'll remind each and every one of you, if you take a look at the SPX, we've had a decent move up thus far. But the SPX this week was actually carrying approximately $82, okay, of expected move. We haven't hit the upper end or lower edge of the expected move. So for all intents and purpose, let's get ready to rumble. This thing is going to move. Now, a lot of people always try to kind of garner like, well, we're going to go higher, we're going to go lower based on the SPX. But I'll make a quick argument over here. There's huge open interest on every major round number, 5150, 5200, 5100. Trying to peg that is an absolute impossibility. Just anticipate that you're going to get quite the little pickup in terms of volatility between now and not only just like Thursday afternoon, but all throughout the course of Friday, as we're hitting just these absolute insane record amounts of options are trading. And options these days, the big takeaway from this evening's video, options are the cart, that are leading that horse around. Obviously, S&P's here slipping a little bit. You can see NVIDIA kind of coming down a little bit. Tesla's actually weighing on markets. But again, no real critical changes. One thing you want to look for right ahead of us, outside of the fact that we've got triple witching, and it's going to increase volatility. So one last aspect I want to mention on this evening's video deals everything with advanced decline line. You're seeing markets right now play what I term the rotation game. Okay, on a day-to-day basis, it's like, oh no, let's get back out of Apple. Everybody out of Apple. Okay, we're getting out of Tesla. We're getting out of Meta. The capitals continue to kind of flow. It's actually causing more like a 50-50 advanced decline line on a day-to-day basis. Even in a marketplace that was ripping to the upside yesterday, the advanced decline line wasn't great. What was ripping to the upside, it was NVIDIA. Like, I hate to tell you, but like NVIDIA, was your market in yesterday's trade. I mean, the explosion to the upside over here took implied volatility through the roof. So lo and behold, what we're seeing, on a day-to-day basis, though, as I said, is like this rotation. We're coming out of NVIDIA, right? We're coming out of Tesla today. We're coming a little bit out of Meta, maybe a little bit of Apple. The combination over here, let's start to see inflows into stuff like financials. There's been big flows today inside of what? XLE, which is the energy sector. Okay. Again, we're playing a game of like whack-a-mole. And the way I always think of this is like musical chairs. Okay. Everything is just fine. You can have a heavy negative advanced decline line and still actually go higher in the markets. But what you want to look for, especially during this triple witching coming up, look for higher degrees of correlation to kind of grip hold. Specifically inside of the S&P 100 here, you start to see 90 stocks trading on higher or 90 stocks trading lower in this marketplace. And I'm going to tell you right now, that marketplace is going to make much more substantiated moves. I think we're right on the verge of actually seeing higher degrees of correlation over here. Remember, I kind of call it the rotation game, or what we term musical chairs. And it's all fun and games until that music stops. Look for this triple witching to be like a big kind of marquee point and a turning point for markets. Thanks everybody for joining us here at TheoTRADE. Have a wonderful evening. Bye-bye.